On a Monday morning in March 2021, a hedge fund manager named Bill Huang had $36 billion. That's not a typo. $36 billion. He made it in just 6 months. His fund, Archegos, was growing faster than almost anything Wall Street had ever seen. But here's the thing nobody knew. Almost none of that money was actually his. Bill Huang was borrowing at a scale that broke every normal rule. He wasn't just investing, he was gambling with other people's cash, and for years it worked perfectly, too perfect. At the start of 2021, Archegos had $4 billion. By March, that number had exploded to $36 million. His secret? Leverage. But not the kind you've heard about. This was a special type of hidden borrowing called total return swaps. We'll get to that in a minute. The scary part? Almost no one was watching him. See, after getting in trouble with regulators years earlier, Huang shut down his old fund and rebranded as a family office. That's a legal trick that lets you manage your own money with almost zero government oversight. No public reports, no mandatory disclosures, just darkness. So on that Monday, March 22nd, 2021, everything looked fine. Archegos had massive positions in 2 types of stocks, old media companies like Viacom-CBS and Chinese tech giants like Tencent and Baidu. Then, after the market closed, a single press release dropped, and within 24 hours, the slow-motion disaster began. That press release didn't just move the market, it lit a fuse, and the explosion would be bigger than anyone imagined. The press release came from Viacom-CBS after markets closed on Monday. They were selling billions in new stock to fund their streaming service, Paramount+. In normal times, that's fine, but for Bill Huang, it was a nightmare. Viacom was his single biggest bet, and when a company issues more stock, the price usually drops. Tuesday morning, the stock fell 9%. Archegos got a call from Credit Suisse, one of their bankers. You owe $177 million, a margin call. That means the stocks you borrowed money to buy are now worth less than the loan. Pay up or else. Huang paid, no problem. He had billions. Then Wednesday came. Viacom crashed another 23%. But that wasn't the only problem. That same day, a new government proposal in Washington targeted Chinese stocks, and Archegos had nearly $50 billion tied up in Chinese companies. By the end of Wednesday, half of Archegos' entire fortune was gone. Now here's where things get weird. At UBS, another bank, a risk manager named Brian calculated the damage. He thought Archegos owed about $350 million. No big deal, he thought. The fund had been so profitable, he wasn't worried, but he had no idea how bad it really was. That night, Archegos asked UBS to wire them $173 million. Think about that. They owed the bank money, but they asked for more cash anyway. And UBS said yes. They just added it to the tab. Meanwhile, back at Credit Suisse, the real number came in. The margin call wasn't $177 million anymore. It was $2.5 billion. Then a junior trader at Archegos made a mistake. A $470 million mistake. He was supposed to pull cash from Goldman Sachs. Instead, he wired Goldman $470 million. On purpose? No accident. And when Archegos begged for it back, Goldman refused. They were about to hit Archegos with their own margin call anyway. By late Wednesday night, the co-CEO of Archegos called UBS with a warning. We might not make tomorrow's payment. The bank still didn't understand what was coming because the real nightmare hadn't started yet. And the man holding the match? He was about to speak. Thursday morning. Markets open. Viacom drops another 6%. The Chinese stocks fell 14%. In just a few hours, Archegos loses half of what little money it had left. Now the real numbers come out. Across all of their banks, the margin call for that single day was $10.7 billion. Let that sink in. $10.7 billion. Archegos didn't have that much money left. They had about 10.7 billion. Let that sink in. $10.7 billion. Archegos didn't have that much money left. They had about 9 billion in total equity. They were underwater. A senior banker called Archegos. Our management expects to see the margin call met today. Translation? Pay us or we shut you down. Archegos couldn't pay. That night at 8:22 p.m., they organized an emergency conference call with every bank that lent them money. All of them. Credit Suisse, UBS, Goldman, Morgan Stanley, Nomura, everyone. Archegos revealed the truth for the first time. They had 9 billion in equity. But their total exposure? The bets they had placed across the world? 120 billion. That's 13 times their actual money. The banks were stunned. They had no idea it was this bad. Then Bill Hwang finally spoke. He had barely said a word during the entire crisis, but now he got on the microphone. He said, "Today was a shock to me. But even after 3 days of heavy losses, we have a strong capital base. Give us more time. We can wind these positions down carefully." The banks listened. Then they said no. They had every legal right to declare Archegos in default, to sell everything, to grab whatever cash they could before it was gone. Friday morning, the default notices arrived. Credit Suisse started selling. So did Goldman, Morgan Stanley. One by one, every bank dumped the stocks as fast as they could. Viacom collapsed another 27%. By the end of the week, the stock was down 52% from where it started. Archegos Capital Management was dead. But here's the question that haunted Wall Street for years after. How did this happen without anyone noticing? The answer would send Bill Hwang to prison for nearly 2 decades. After the collapse, regulators had one question. How did nobody see this coming? The answer was hiding inside a complex financial tool called a total return swap. Here's how it works in simple terms. Normally, if you want to buy stock, you put up cash. But with a swap, you make a deal with a bank. You put down a small percentage up front, say 20%. The bank buys the stock in their name. If the stock goes up, the bank pays you the profit. If it goes down, you pay the bank. It's a way to control a huge bet with very little money down. Most banks use something called dynamic margin. That means as the stock price changes, you have to keep that 20% cushion at all times. But Credit Suisse made a deadly mistake. They let Archegos use static margin. Static margin means you put down 20% once, and that's it, never again. So as Hwang's bets grew bigger and bigger, the money he had sitting at the bank stayed the same. By 2020, his effective leverage on some trades was 17-1. For every 100 he bet, he only had 5.90 in his account. Credit Suisse noticed this in September 2020. Their own risk team wrote a report saying Archegos was too risky. But they didn't stop him. Instead, they asked nicely for more collateral. Hwang ignored them for months. He dodged calls, canceled meetings at the last minute. By February 2021, Credit Suisse demanded an extra $1.3 billion. Archegos said, "We'll look at it," and never did. Meanwhile, Hwang was doing the exact same thing at other banks. Nomura, UBS, Morgan Stanley. None of them talked to each other. Each bank thought they were the only ones taking the risk. They were all wrong. When the dust settled, the losses were staggering. But one bank walked away almost untouched. And it was all because of that $470 million mistake. When it was over, the numbers were brutal. Banks lost a total of $10 billion. Credit Suisse took the biggest hit, $5.5 billion. Nomura lost $2.9 billion. UBS lost $2.9 billion. Morgan Stanley about $1 billion. But one bank reported 0 losses. Goldman Sachs. Remember that junior trader who accidentally wired Goldman $470 million? Goldman never sent it back, because they were hitting Archegos with their own margin call at the exact same time. That mistake saved them over $1 billion. Bill Hwang's fate was sealed. In 2022, the SEC charged him with securities fraud. Then came the criminal charges. 11 counts including market manipulation, wire fraud, and racketeering. At trial, he was found guilty on 10 charges. The judge sentenced him to 18 years in prison. But here's where the story takes one final twist. Huang appealed the sentence. He's currently out on bail, free, and in January of this year, he did what almost every convicted fraudster tries. He asked President Trump for a pardon. Trump has already issued over 1,600 pardons in his second term, including several other high-profile fraud cases. So today, Bill Huang is still a free man, waiting, watching. The SEC tried to close the loophole he exploited. They wanted banks to publicly report large swap positions. But the new SEC chairman threw those rules out after the 2024 election, which means the same secret leverage that blew up $100 billion in value. It's still legal, and somewhere right now, someone is using it again.